We begin this hour with fresh numbers. The U.S. labor market is holding steady, this despite the Federal Reserve's aggressive attempts this year to slow down the economy.
The November jobs report showed 263,000 jobs were added last month, while the unemployment rate held at 3.7%. Now, fueling those numbers were gains in hospitality, healthcare, and government jobs.
But we're also seeing some major tech and retail firms announce widespread layoffs as well. The New York Times reports Amazon alone is expected to cut 10,000 workers. What does this all mean? Let's bring in CBS News business analyst Jill Schlesinger to dive through all the details for us. Jill, happy Friday.
Happy Friday.
Great to see you and have you here with us. These are strong job numbers, but in the context of the Fed trying to cool down the economy, how should we read into the data? Is this positive or negative news for the rest of us?
Yes. Okay, that's just a joke. Okay. The reason why I say that is that the job situation has been evolving this year, right? We had a huge year last year. 2021, we averaged more than 560,000 jobs a month for the whole year. The first 3 months of this year, we were averaging about 500,000 jobs a month. Now we're coming into the last 3 months of the year, right? And we are seeing the deceleration. So we started at 500,000 a month. Now we're at about 250,000 a month. This one report for November did come a bit hotter than expected. So we did see that higher number. Previous 2 months got some revisions, but I think the consistent theme is we are gradually slowing down. Job growth is decelerating. It may be that it's not coming down fast enough to satisfy the Federal Reserve in terms of if a lot of people are working and companies are hiring and consumers are spending, we are likely to see inflation remain higher than they would like or we would like.
So on that note, Fed Reserve Chair Jerome Powell has said the Fed could ease the pace of its interest rate hikes as early as this month. Jill, how do you think these numbers affect that?
I think this lays credence that they're almost done, but they're not there yet. So we had 4 Fed meetings where we had a 0.75 percentage point increase, which was an enormous amount of movement. We started this year with interest rates, Fed funds rates, at 0. We are now at 4%, probably going to 4.5% within 12 months. And I think what the Fed chair is trying to say is it doesn't really matter. We are keeping these interest rates higher for as long as necessary to see the economy cool and prices come down. Where do we see the real activity cooling? In the real estate sector, right? Where activity is dropping off. But prices have been slower to follow. And I think that really means that next year we are facing these higher rates that will stay in place for a bit longer.
Let's drill down on that a bit more, because the areas of the economy doing well as far as job demand are in services, not goods. And we do know that the transportation and warehousing sectors, so to speak, lost 15,000 jobs in November. So what does that tell us about which parts of the economy are strong and which parts of the economy are slowing down?
I think this is a reversal of fortunes, right? During the COVID pandemic, where did we see the huge job losses? Leisure and hospitality, manufacturing, it just shut down, fell off a cliff. And at that time, amazingly, technology companies were hiring like crazy. They couldn't keep up with the demand. Now that's turning over. And now we see technology companies laying off. Now that commodities prices have come down, manufacturing, some of the goods producing part coming off. We saw retail lose 30,000 jobs last month. But interestingly, what did we see as the bright spot in November? Leisure and hospitality, which added 88,000 jobs. And even though that there is some concern that people are not going out as much and they're not traveling, well, they have not yet. They are still seeing a lot of strong demand. And I think that if we kind of consider where we came from in the pandemic, we start to say that 2022 is our year of transition. We're going back. In statistics, they say we're regressing to the mean. We're going back to that set point. We're not there yet. But the labor market was upended during the pandemic. The entire economy was upended. This is this transition year where things should get back to what is a quote-unquote more normal-looking U.S. economy.
Before we let you go, Jill, I'm just wondering, you mentioned real estate a moment ago. You know, for those first-time home buyers out there, is there any glimmer of hope here looking ahead to 2023?
I think that if you're in the market to buy a home, you really have to go and crunch those numbers over and over. Now, I don't believe that we are going to see 10% 30-year fixed rate mortgages, so I don't want people to be fearful of that. We were up above 7, now we're in the 6s. I don't think you're going to see 3% 30-year fixed rate mortgages anytime soon. And I also think that until prices come down, we are going to see a lot of those would-be first-time homeowners on the sidelines. Maybe the only good news, I think rents are going to start to come back to earth. So that would be good.
That is one bright spot at
All right,
least.
move in with your parents.
Okay, Jill. All right, Jill Schlesinger. Jill, thanks very much.
Thanks, Jill.